Everybody, this is my Lemonade update video since we had our Q2 2025 earnings. In this video, I want to look at how will the rest of 2025 look? When will or might the first adjusted EBITDA positive quarter come? So when might we have that quarter? Will 2026 full year be adjusted EBITDA positive, neutral, or negative? So we'll try and answer that for next year. How confident can we be in the present value of Lemonade stock? What we think Lemonade stock could be worth right now. And then what might be the sort of base worst case scenario, sort of the low end of what we think of this Lemonade stock could be worth right now. And I'm going to try and keep this while keeping as much detail as I can and packing that in here, also trying to keep this appealing and interesting and understandable for people that are new to the stock, because I know a lot of people are diving into Lemonade. So with all that as a nice little intro here, let's dive in. And I should mention, if you do, I've been hyping this video up, talking about this on my Patreon here. I have my Lemonade model that's available here that we're going to be looking at in some detail on my Patreon. If you want to join my Patreon, I do encourage you. The lowest tier was sold out. The next tier, $5 a month, has a number of spots, but it is filling up. And then we'll go to $10 a month and on and on. But I really appreciate everybody who's supported the channel there and is looking deeper at Lemonade. Super awesome to have you all. So first of all, let's look at the guidance for the year. So for Q3 and 2025, in-force premium, I'm just going to look at the high end because Lemonade generally give a range, but they almost always hit the high end or better. So in-force premium for the full year, $1,218 million. We have $715 million revenue, $135 million adjusted EBITDA loss. Adjusted EBITDA is just your EBITDA, but with some few other little adjustments that Lemonade makes. And they report on that. And they've said for a number of years, I think it's like 4 years or so already, Lemonade management has said, hey, 2026, we're going to be adjusted EBITDA profitable. In the last earnings call and Q2 earnings call, their CFO said they might hit adjusted EBITDA profitable for the full year. But they've been saying for 4 years, 2026 is the year. I've always assumed, it's always kind of been that 2026 is going to be the first quarter will be in 2026. But they did sort of suggest it's possible. They didn't say it will be. They're not guiding to that, but it is possible 2026 could be on the full year, the whole balance, adjusted EBITDA profitable. And then they've said for a long time, management said 2027 they're going to be GAAP income profitable. And so that's what we're going to see in my model here. We'll start looking at it. So starting at the top of my model, let's just look at Q4 for 2025. I'm modeling in-force premium, in-force premium is just all your premium that's on your book at any one time. So at any one time you looked at, December 31st, I'm suggesting they're going to have $1,228 million of policies or premium on their book. And then that converts, I'm projecting about 30% growth. I'm projecting, they're going to beat this top end by 10 million. They sometimes they tend to beat it. So I don't think that's, it's probably makes sense to assume they beat it by a little bit. And we might look at it here in the video where if they just hit the high end only. But say they beat it by 10 million, that means 30% growth. And Lemonade Management has also said since Investor Day last November that they plan to reach 30%, accelerate up to 30% growth, and then be hitting 30% growth or better for a number of years as they 10x the book of business. And they were 29% growth last quarter. So it makes sense. You're 26, 24, 22%, 24, 26, 27, 29. Now you're going to start hitting the 30s is where I think it's going to go. And if you're hitting 30%, then you're going to be beating the top line, that estimate by a little bit. If you're only at, 1,218, you're now at 29% year-over-year growth. So that's kind of what they're projecting for their guidance, 29%. But I think there's a pretty good chance they do 30%, something like that. And then gross earned premium is just I just take it as a percentage based on historical trends here of your in-force premium. And gross earned premium is just the in-force premium that's flipping over and becoming earned. So each quarter, it's about roughly a quarter or a little less than a quarter, especially if Lemonade is growing faster. So it depends kind of on the rate, the policy, if a policy is only for 6 months, then it may come sooner where the policy's done and then it becomes earned premium, that kind of thing. So Reinsurance is a portion of the premium that Lemonade is giving over to reinsurers, who are then going to help them protect them from downside risk. And they've been about 55% for a number of years, and now they are dropping that down to have that scaling down based on comments in Q2 letter and call, scaling that down to 20% by Q3 of 2026. And I'm not going to go through all the details here, but there's different ways you can, again, get my model on my Patreon. It's only $5, and you can look at this in more detail. But you get down to revenue for 2025 based on where, I'm projecting a few things, where their investment income comes in at. There's this commission and other income line where that's sort of as a function of your earned premium, where that comes in at. I'm at 714, if you look down the corner here, 714, almost 715 million of revenue. And that's right in line with the top end of their guidance. So I think so far, this kind of makes sense. You're at okay, revenue for the rest of the year, 715 million. We can be pretty confident they'll probably do that, maybe even slightly better than that. Maybe this is even a slightly better beat, or some of these values in here are slightly better, and you might be just a little bit better than that. Gross loss ratio, we're going to play around with this as we look at some of the values here, but I have 67, 65%. I'm not saying that's what it's going to be, but your loss ratio is just the percentage of your claim, of your premium that's paid out in claims, and also includes the costs of adjudicating those claims and managing those claims and checking for fraud within those claims. All that sort of expenses related to the claim side is put inside of there. So if you have a 70% loss ratio, it means 30%, is left over to cover your operating expenses and then take a profit as well. So Lemonade, it's been trending down. And loss ratio was a lot higher when the inflation was much higher for Lemonade, or inflation was much higher. It was really rampant over the last number of years, and that really pushed the cost of things up. And then it takes time for an insurer to get their pricing checked, to get regulators to approve price changes, and then to see those big policies sold, and then see those policies show up in the financials. But now they're in a really great place. It's 67% gross loss ratio, and on a net loss ratio basis, we're 69. So I'm projecting 67, maybe even 65 in Q4. Q4 of last year was 63% and was 62% net loss ratio. So I'm sort of projecting maybe 65, 66%. Right now, you can adjust these values and see the effect, right? And maybe there's a big natural disaster in Q3 or Q4. We don't know, and this could really affect where the values come in at. But you get that's sort of where I'm putting in for those values there. Annual dollar retention, which is just a bit of a function of how your it's a metric that looks at, hey, how much premium from a cohort of customers 12 months prior are still there now. So I have it at about 84% over the next 2 quarters, and then it's going to slowly rise up to around close to 90% in later quarters and years. There's even a chance annual dollar retention could just go bananas, because if a cohort of customers starts churning away, maybe a whole bunch of customers you have from 12 months prior, they all churn and leave, but a portion of them turn away and leave, but then also a portion of those customers, a bigger portion, stay, and maybe they upgrade their policies. They get another pet policy, or they get another car policy, or they start as a renter and then they get 1 or 2 car policies under the same account. And so you can really increase your annual dollar retention. You theoretically could go above 100%. I have way down, I'm just going to put like a little marker here so we remember annual dollar retention where we are right there. But if I scroll way down in my model, I have like a breakdown of all the different products and lots of data on each sort of product, how it's broken down. And you can, within that, you can, based on your policies per customer. So you can figure out your policies per customer, and I have that sort of slowly ramping up as car ramps up, and that affects your annual dollar retention, how fast that ramps up. So if that ramped up, way faster, and car really pushed pedal to the metal in 2026, your like annual dollar retention could go a lot higher, faster, and that would help all of your metrics in 2026, 2027 in that range. So I don't know if that will happen, but that could happen. And yeah, but what I think I'm modeling it fairly conservatively. We're around 84%. It dropped from, we were historically more like 88%, even 87%. And it dropped because they had to non-renew, basically cancel a lot of policies that were home customers that Lemonade realized, hey, these customers are just not going to become profitable quick enough, soon enough. We have to get rid of these policies. So that's hurt them from 12 months ago. They were doing that. Now you're looking at that. Then as those sort of end, you're going to see annual dollar retention start to rise. Even they said on the earnings call, Tim, the CFO, said that the annual dollar retention 84% was about 4% off of what it should have been, just because of those non-renewals. So 88% even, I think that's super conservative to sort of show as car ramps are at 80, sort of 88 to 90% range over 2026, 2027. So pretty conservative, I think we're at there. Within that, you get customer churn. It's going to I calculate that separately. It's not released by Lemonade, but it's been in the 16% for a while. It rose again, I think in part because of non-renewals, and now we're going to see that kind of trend line phase out. Now, a big part of the model here, understanding sort of the financials in detail, is your sales and marketing growth spend. So Lemonade reports have operating expenses, they have sales and marketing, they have what they call other insurance expense, which includes a bunch of things. It also includes like payment, credit card fees, that kind of thing. It has tech development and general administrative expenses. So those are their categories. They're what they lump things in. But within sales and marketing, they used to not give this management as clearly, and then they started to really present this really clearly in letters and in earnings calls, which has been great. Is a portion of the sales and marketing that is what I call sales and marketing variable, or the growth customer acquisition, or CAC spend. So you say sales and marketing variable and sales and marketing fixed. Sales and marketing fixed has been really consistent around like $10 million a quarter, and even going down some, and I have it around 10 million and slowly increasing onwards. And just because that's kind of like your staff, your overhead staff, fixed costs, sales and marketing fixed costs, and then your sales and marketing variable is how aggressively they're spending on Facebook ads, on Google ads, on YouTube ads, et cetera, on billboards out in public. That's how much you're actually spending on your ad campaigns. And if I flip over to a model, or just a graph of this growth spend, you can see that as inflation, here's quarter by quarter how much they spent on this growth spend. As inflation, they were accelerating it, and then inflation got really bad, like around 2021, and they really paused, put the brakes on their growth, slowed down growth, conserving their growth spend, because you don't want to get customers that are not profitable customers. But then as their rates caught up with where they needed to be, their loss ratios came in check, they've ramped up their growth spend, and they're going to continue to ramp up their growth spend. And in the Q2 call, Tim, the CFO, gave it really, really nice, made my life really easy as somebody modeling this for Lemonade for Q3 and Q4. He said, basically said the whole year, and they said it was around 173 million, 174 or so that they're going to spend on growth spend this year in total. So we know what they spent the last 2 quarters. And then he basically said Q4 was going to be the same as Q1, which was 38 million. And then Q3 was going to be, I think he said similar, or around 48 million or so. But together it's going to be around 173 million. So you can make the numbers work for all, based on, we already kind of know roughly where if you go 30% growth, a little bit of a beat, where their IFP is going to come in. And now we know how much they're going to spend on marketing. So a key variable we can measure in past quarters, I'm calling your conversion of customer acquisition or growth spend. It's all the same terminology, CAC, your growth spend, your customer acquisition spend, your ad sales marketing variable, whatever you want to call it. The dollars you're spending there, you're converting that to how much in-force premium you're getting. And so historically that's been 2.37, 2.74. And if we look at a chart of that, the bars being that ratio and then the blue line being how much they're spending on the growth spend, see, as they spend a lot less on growth spend, the efficiency of your marketing went up, but then as you spent a lot more on growth spend, the overall efficiency went down. So it's a really important thing to realize, like, where, as you spend more and more and more on growth spend, where is this efficiency going to end up? And I should also mention, if you just look at, I call it sort of, if you just looked at a net change in IFP, said, hey, we gained, went from 1,008 million to 1,083 million, and you looked at the net change of IFP and said, hey, that doesn't quite square now, that change with your math paper bag. Well, that's because I'm also I'm factoring in the amount of IFP based on your annual dollar retention, based on the changing premium per customer between customer cohorts. I'm factoring in the amount of IFP that's leaving. So that's what I call your IFP acquired is important versus IFP net change, because net change would just be the difference quarter to quarter, but IFP acquired is like the amount that's coming into the business. There's also a portion that's leaving the business, the customers who churn away. So but I think it's much more important to measure what's coming in. You can also measure what's leaving, of course, but if you measure what's coming in, that's sort of an apples comparison between the quarters of understanding where this marketing efficiency can come in at. And then based on that, you can project the next couple quarters, how much they're going to spend on where that ratio might be, and then based on their growth spend and where they're headed to. Also should note, I know I mentioned this in a lot of videos, but I'll mention here again, if you're new to the Lemonade thesis, is that as this has come down, but as they ramp up car, this is going your marketing efficiency, this ratio, I guess I'm trying to say, is a function of how much you're spending on growth, but it's also a function of the number of products you have, how big the sort of product opportunity of those products is, and the geographies they're in. So, if you only sell, renters insurance in Wisconsin, you're going to have a certain a sort of market of people looking for that product at each quarter, and that's sort of up to finding those and converting those customers. You have a certain sort of efficiency, and then after that efficiency, you would trail off. But if you have renters insurance across all the United States, well, suddenly it's a way bigger market, and you have pet insurance, it's a much bigger market again of where you can effectively spend sort of fruit. It's like your orchard is growing, and every quarter you get fruit on the orchard you're trying to pick. And because if you grow the size of your orchard and there's more products and there's bigger trees and there's more space, well, now you can deploy more capital in growth spend, and still you're going to get that healthy conversion rate. And I will pull up here my my marketing efficiency chart, and this is a chart of each quarter's the CAC spend again versus that conversion rate, that ratio, where you ended up on the quarter. And you see sort of a trend line. Yeah, you got super efficient rates when you weren't spending very much, when there's high inflation. But then as you can see, the worst rates are when they had the least products, like 2020, 2021, when they just had, renters insurance and pet, maybe a few places. But then as they roll out more products in more places, you're spending more, but you're going above this trend line more and more. And my thought is, these are rough numbers, but pet insurance is like $5 billion or so in the U.S. It's growing rapidly. Pet insurance could be like tens of billions if you fast forward even a few years. So that will grow even on its own. And renters insurance is also growing, not quite as fast, but growing. But it's also maybe, right now it might be $5 billion a piece, renters and pet. And you're talking about car insurance in the U.S. might be $300 billion. So it's a huge, multiple bigger market that they're just scratching the surface and kind of going into. Of course, bigger market's more competitive, but if you have a very compelling car product, well then, it's going to be, you could really win the bet. You could still be very effective marketing conversion rates. But I think we're gonna see rates values that kind of keep defying gravity, even as they spend more and more and more dollars and push into this 2 range. You might even have rates above 3, but typically I'm modeling, flipping back down to the numbers, sort of in the vacuum out into mid 2030s. I have 2.5 as that ratio, and you can historically see we've been at 2 point whatever, between 2 and 3 is where most of the data is shown up at, and the few odd ones where we had much less spend. So I think they're going to be able to continue to defy gravity. Last quarter was 2.37, and based on where we're headed and what these numbers show, I'm at 2.45, 3.21 for the next 2 quarters. Synthetic agents, I have at about 80% coverage. That's financing agreement that Lemonade has that helps them pay for this sales and marketing growth spend. And then as they turn profitable, I believe they will turn off the synthetic agents at some point. But right now they are using that, and I expect them to use that again all of next year, maybe even 2027, but I don't have it modeled that way right now. And then you have other insurance expenses, tech development, G&A, all those operating expenses together. You can see your total operating expenses, and also total operating expenses minus growth spend, because this is the main sort of discretionary spend line, this growth spend line. So if you go total operating expenses minus growth spend, I have that growing around 4 or 5% a year, sort of going out into the future. If you look back at Investor Day presentation by Tim, there was a graph there that sort of suggested you get they expect maybe around 5% annual growth in that. Okay, so I hope you're understanding the model better. You're getting into it deeper and getting a better picture of it. Now we're going to start to actually answer this question: how will the rest of 2025 look? Okay, because it's pretty interesting, and also I think how the rest of 2025 look ties in with when will the first adjusted EBITDA positive quarter come? These two questions are actually kind of tied together, because I think there's actually a pretty solid chance. I think it's much more probable than people realize, and it sort of surprised me even, but I think there's a pretty decent chance that we get adjusted EBITDA positive in Q4 of this quarter. Now, I said earlier in the video, they thought, I don't know if I did say that, but if you look at their guidance, they have $135 million of loss for the whole year, $34 million in Q3. And if we look at adjusted EBITDA, we had $88 million for Q1 and Q2. So if we say 135 minus 88 minus 34, it means you have about $13 million loss they're projecting right now in adjusted EBITDA for Q4. But based on these numbers I'm putting in, which are not outrageous numbers, you're getting to, very close to break even for Q4. Now, the reason they might be guiding this way is they don't really know what the loss ratio is going to do, right? So I have right now 66% net loss ratio, 65% to get you there. But say, and I don't think that's outrageous, because even Q4 of last year was 63% and 62%. So there's potentially, say you do 61% and you do 62%, you could have a 9 billion positive Q4. I don't expect that to happen. There's also, uncertainty in all of these, all the sort of assumptions we're making here. But if you have to get to sort of minus 13, you probably need like a 75%. Your loss ratio basically has to be like 75, 76% net loss ratio. That will get you back to the minus 13, minus $14 million adjusted EBITDA loss for Q4, which would be more in line with guidance. So it's almost like, hey, they're guiding for, which could happen, like Q1, we had 78% and 82% loss ratio because we had those LA fires. So there is a chance that happens, but if that doesn't happen, I mean, I think I would honestly, if I was a betting man, I would probably bet money that Q4 gets very close or even turns Adjusted EBITDA profitable, which I think is going to surprise the market already. So I was hinted at this video, said I think, people are going to be kind of surprised. I was sharing some of this in my Patreon. I think people are going to be surprised with how quickly the sort of numbers start turning around, because I think these numbers are fairly, conservative, fairly sandbagged, and they're being conservative because you wouldn't know. They don't know exactly how it's going to work out. They'd rather be conservative, and then they can give better guidance. We'll probably see some of that shift even in Q3, because you don't get Q3 results until you're already partway through Q4. So they already kind of know Q3 partway through part of Q4 how it's shaping up, and then they can give your guidance in Q3 for Q4. So but I think it's pretty, we might have, based on all of these inputs. And if you go to, 67%, 68% net loss, well, now you're almost at break even. It's right around there. If you go 66%, 67% net loss, now you're flipping to positive. Now, one thing that, it could affect it is you could say, maybe your IFP is not as high. So maybe they don't do quite as well, but I'll just move this down to 1218 IFP. And then I'm going to adjust. The way I model it is I also input this ratio, and then it figures out the way I model it is you have a set IFP growth rate, and then you input a ratio of CAC spend to IFP. And so I did this earlier, but the adjustment here would be this goes to 2.9, and then you're back at your 173, 174 million spend for the year, roughly, right? And then that's still, even with those two changes, you're still at nearly break even, basically zero. So if I flip those two changes back to 1228 and that, now you're in a positive, 1 million. So it adds a, million something. Now, if I flip those back again to 2.9 and you're 1218, exactly what they've guided. And then you need like a little bit better loss ratio. You make it 1% better on your loss ratio. Now you're already flipping it positive once again. So I'm going to flip all these back though to where, sort of set it back to where I typically have had it. It's very possible. I think this could happen. And if you look at full year, let's look at that. So sum of $104 million loss, and again, their guide for the whole year is $135 million loss. So to get closer to 135, you probably need loss ratios that are, I'm just going to take a stab at this, say 75% and 76% net. And now your Adjusted EBITDA is minus 130 million. So if you 100, even if at least what I'm modeling with this top line, even if you do 75% loss ratio, you're still going to have a little bit of a beat on the overall Adjusted EBITDA loss. But loss ratios have been getting just better and better and better. And if I flip to a graph of the gross loss ratio on a trailing 12 months, you can see, they got bad as inflation again, but then it's been consistently trending down on the average. So it makes sense to me that, if anything, they might start to do better than they did in previous years. Now, something we don't know for sure is how aggressively they start ramping car and where those loss ratios come in at. So car loss ratio, gross loss ratio is 82%, but has been coming down. It was 88, 83, 92, 95 was higher. And we're going to probably continue to see that improve. So maybe car starts shifting down into the 70s range. And as an overall book of business, and new our customers that have stayed on with car and have become the best car customers have really low loss ratios. They pull that down, and they've been growing car, but not like crazy gangbusters, wild growth in car, but they are growing car aggressively, and they'll start to grow car aggressively. So that might even be some of the uncertainty where they project out and show their own guidance around what the the loss ratio could be. But I think these numbers, if you're answering how will the rest of 2025 look, real good. I think it's going to look really good versus what's being guided. And then when will the first Adjusted EBITDA positive quarter come? We'll answer it more as we look at 2026, because there's a chance it's not in Q4, but I think there's a pretty good chance this could come in Q4, depending what loss ratios you put in. Like, let's say I go back to 67, 65 here. There's a chance Q4 we're hitting it. And I did do a poll on this. Let's find that here. And I said, get out of the way here. When do you think Lemonade will have its first adjusted EBITDA profitable quarter? I was doing this as I was thinking about this and realizing, actually, I think, it's a decent chance it's this Q4. And most people are answering first half of next year versus next half of next year, or, versus people saying it's not going to be till 2027. But I really think this, I did this poll just to sort of gauge where people are thinking about this, because I think we could be a bit surprised, and it might come sooner. So now let's look at the next question. When will 2026 full year adjusted EBITDA be? Will the full year be adjusted EBITDA positive, neutral, or negative? So 2026, if we look at that, I have the top line growing a little faster, accelerating up to 32%. If you look over the next number of years, I kind of have it, as they grow bigger and bigger, I have it slowing down a little bit into high 20s, and eventually, rolling up into basically doing a 10x from the end of 2024, when they talk, 2024 end of that year, to the end of 2033. So over that, about 9-year span, doing compounding or growing or 10xing their book of business. And so by 2026, though, I have 32% there. We're not going to go through all the details again, because I hope you get a better understanding of my model now. But loss ratio, just inputting a value, sort of an average value across the board, not trying to detail into each quarter, but say 70% net loss ratio, 69% gross loss ratio. And then scrolling down, based on the CAC, your CAC spend to IFP acquired, I have 2.5 again as an overall average. And that, of course, oscillates some because certain parts of the year are better for marketing efficiency than other parts of the year. But I have 2.5 for across the board there, and then if you look at an average of the last year, I'm showing 2.69, and so 2.5 again. That's what I'm modeling going out into the future. Same synthetic agents, same kind of approximate increase, 4 or 5% in operating expenses minus growth spend. But if I scroll down to the results here for adjusted EBITDA for 2026, I'm getting a positive 1.9 million with these inputs. So a slight increase, slight positive full year adjusted EBITDA value. And again, depends what you put in here. Maybe you think, it's going to be 2.25, right? And for the marketing efficiency, let's pull back here and change those 2.25. And it's like, well, now your sum for the year is minus 20. And you have only, Q4 flips to positive, but it's not nearly as efficient because you're spending a lot more marketing to get the same amount of growth. So flip these back though, the 2.5. So this is a really key metric, where this could end up and showcase. And then of course also your loss ratio. Maybe your loss ratio is not 69. Maybe it's better than that. Maybe it's 67 across the board, right? And if you scroll down, well, now most 3/4 of the 4 are positive. You have positive 22 million of adjusted EBITDA. So it depends. Will it be positive, neutral, or negative? It is hard to say. I think there's, again, a pretty good chance. If I flip these back to 69, say, I think there's a pretty good chance we do hit positive, or it's very, very close. And regardless, I think, I've said it before in other videos I did, that I think this guidance will come in probably February of next year. There'll be the Q4 earnings call, but it'll also give the guidance for 2026. That guidance could really hit the market like hard in a good way, and surprising the market. If they're not already surprised by the pump the brakes here. I didn't really think about this even before I started filming this, but more reason to think that February could be major sparks, because your Q4, is a surprise beat. Maybe they have, next quarter they improve their guidance, and then, adjusted EBITDA loss or Q4 says minus 10 million. But then maybe they blow that out of the waters, they beat that, and they post a Q4 results come out plus 2 million maybe on the quarter. Meanwhile, they say, hey, next year, maybe they don't guide as aggressively as I'm showing, but they say for the whole year, we're going to have a, $5 million loss. And then you go from, right now where the market still looks at this and says, when are they ever going to become profitable? They're minus 135, minus $140 million adjusted EBITDA loss for the full year. And just a few months away from that, we're talking from now until February, they could be posting a positive quarter, and they could be saying, look, 2026, we're going to be close to break even for the full year, as well as quarters that are, of course, positive. Within that, maybe 2 or 3 of the quarters will be positive. That could be really shocking and surprising to the market. I kind of secretly hope that Lemonade almost stays a little bit secret and cool from a stock perspective until that February, and then I could, you could probably do very well on not financial advice, but I would definitely look at and consider more options, we would say, within the market there, maybe even shorter term options around that earnings date. I could see that. And again, not financial advice. Every person can do whatever they want with their own money. You don't even have to buy Lemonade stock, but you totally do what you want. Do your own due diligence, of course. But for myself, I would probably consider some, or even a small portion of my portfolio going that way instead of just shares like I typically do. But I have a feeling that it's going to become more and more obvious to the market, and the moves we've been seeing in recent weeks are only going to continue. And and I don't know if the secret's going to hold until February. But if it did, or some reason the market turned sour, because the market does all kinds of crazy things, oh man, the Q4 earnings could be major, exciting, positive fireworks, would be my opinion, at least. Who knows how the market will perceive and react to them. It's hard to understand or know that or guess that. But I would think, based on there's a chance Q4 is going to be a strong beat, and the full year has a much better chance than people realize of being positive for the full year. And even Tim said in the conference call for Q2, or in the earnings call, that we're not guiding for that, but we might be positive. So it's showing right there, you're going to probably have at least 2-3 quarters out of the mix positive. And again, if you want to play with these numbers more, I'd say just join my Patreon, get the model. You've watched this video, you're going to understand the model in a lot more detail. There's also an introductory video when you join the Patreon that shows you kind of the basics of it, and you can play with some of these yourself. So let's moving on to share value of Lemonade. So what would the company maybe be worth right now, and what might be the worst case sort of present value now? So just looking again, I'm going to just move this. I'll just move this out of the way as we kind of flip up here. Look outwards more. So again, by the end of 2033, have that's roughly sort of 10 billion of IFP. I have a net loss ratio of 70%, gross loss ratio of 69%. Churn, I have kind of coming down to 15%. I think as car rolls out, more customers, or you're a bigger and bigger customer base of sort of solid committed customers, you're going to have churn even improve a little bit more over what it's historically been. Again, I talked about your customer acquisition to IFP growth span of 2.5. Sales and marketing growth, well, all your other sort of fixed SMM growth, all your other operating expenses growing around that 5%, 4 or 5% per year. And you project out down here, I have a PE value based on where your earnings come in, your earnings per share, your net income comes in. I have a PE value, say at 2032. So if you say, hey, at 2032, it's a 2030, it's greened right there. I'm going to just ungreen that for this video, because that was in the past I had that green. But 2032, you might say, hey, look, based on their earnings per share and based on where you'd say a 30 PE, it might be worth like, $200 of a share by 2032. But if you say, if that's discounted back 10% per year to today, well, that means Lemonade's worth something like $96 a share right now. So you could buy Lemonade, $96 a share right now, even pay that rate, even if it jumped to $96 a share tomorrow or next week, you could still buy shares at $96 a share and still make 10%, probably beating the market overall, still make 10% over the next number of years between now and 2032. Now, if you look at it from 2035, if the market says, hey, they're worth a 30 PE, 2032, they're not even at their 10 billion yet. The end of 2032, they're worth like $7.5 billion of premium. Still tiny insurer, relatively tiny insurer, and tons of growth potential. So you might even say, look, why would the market? They're still growing high 20s, 30, low 30% growth. Why would they only get a 30 multiple? I agree with you. Probably should even be higher. Maybe it's a 40x multiple, and you could say, well, now they're worth $128 per share right now, and you can still make your 10% return. Maybe you say, yeah, I want to make 15% even if I buy it. Well, then you could, depending on if it's a 40x multiple, 15%, well, now you're at a $92. You're back sort of in roughly the same spot. But if I reverse those 10%, 30 PE, you're still saying, hey, $96 a share. Now, if you look out further, because you still say, yeah, they're going to keep executing. Why are they stopping there? 2032, they're going to keep growing. There'll be $14+ billion of IFP, still a massive market. Why can't it become the next Progressive, grow to hundreds of billions of dollars of IFP? That's my, ultimate prediction. I think Lemonade will, I think it's more likely than not likely. I think it's more than 50%, even like 75% chance they could still 100x from where they are, turn into, maybe $400 or $500 billion company, bigger than the biggest insurers right now, as the insurance market itself just grows larger and larger, and they become the better than the even best sort of legacy insurers now. Why wouldn't they be able to do that? You've seen that over and over again in other industries that have been massively disrupted. So if you look out further, then you're like 2035, if they have a PE of 20, then because you say, well, maybe there's harder to grow the bigger you get. So maybe the market only gives them 20x PE. Well, now you're worth $400. Then you discount that back to today. It means you're worth $150 a share right now. Again, just means you could buy Lemonade. Lemonade could go to $150 a share next week. You could hold it for the next 10 years until the mid 2030s, still beat the whole overall market as a whole, make 10% a year on your money, grow from 150 a share to 400 plus per share. And say you think, wow, 20 is going to be still too low, because even at the 100, they only have 14 billion of IFP. Why couldn't they have grow to hundreds of billions of dollars of IFP? So maybe the 2035, the market's going to be still super bullish on them, and you're worth 40x PE ratio. Well, you're still going to be worth, you're still worth $300. You're saying then it's worth $300 a share. You can make the case that Lemonade honestly is worth like $300 a share right now, because if you think it's going to 100x for the next number of years, then it should be worth, that sort of fair value right now would be the fair value. Of course, there's uncertainties the further out you go, so you have to sort of account for those uncertainties. But within that, you could say, okay, 150. I think Lemonade's easily worth $100 to $150 a share based on those inputs. How confident can we be present in the present value right now? I think it's 100, 150. You start going over 150, yeah, you can easily make the case it's worth like $200, even $300 a share. But I think it's obviously less certain, but easily still at $50-$60 a share where we're at right around now. I can confidently say myself, at least, I think it's pretty undervalued based on the inputs I've put in, which is kind of a base case. You could even be more, I'm just going to move this out of the way again. You could even be more bullish and say, look, they grow a little bit faster. They get there sooner. Their marketing efficiency is in 2.5. It's actually like with car rolled out, it jumps to, 2.9, let's say 2.9. I'm just going to change this. 2.9 across the board there. And he jumps up and he says, even at the exact same ratios, you're saying now it's not worth 90 to 150, it's worth 116 to 164 within that range, right? So it all depends, and maybe the loss ratio could get better. Again, I'm at the 70%. I'll flip that back, this marketing to 2.5. Now, let's try and answer our last question, which is what would be the worst case present value now? So let's say a big one here is your marketing spend. Let's just say your marketing drops to $2, the conversion, or $2 of IFP for $1 you spend. So 2x conversion. I'm just going to paste that in there. And let's just see, we were at like 90 to 150. Now the same ratio, now we're suddenly at like 60. You're still a profitable company. You're still going to grow. You're still going to make profits. You're going to take longer. It's going to be harder to get there in 2026. So even I don't think this is already realistic. I think this is too bearish, too pessimistic. It doesn't even follow guidance of what management says for 2026, 2027. And they've been confidently saying this, beating the drum on this for, again, 4 years or so. But within that, you get to $60 or $124, per share. So you're still, even then you're like, yeah, you could buy at $60 a share and still make 10% a year for the next, 7 years or so. And even if you... And depending on what you think 2035 would be worth, you could buy it for even a lot more than that because it keeps scaling the business. And you could still say, yeah, even at that amount, you're still very profitable. Now, let's next biggest thing to change would be the loss ratio from let's call it a 75% loss. Whoops, no, it's 75% loss ratio. And I'm just going to do that for all of these quarters. And let's see where that moves the needle on our profitability. Well, that has a massive effect on profitability because you're shaving off sort of 5% of your potential margins. And, insurance in general is not a high profit margin business. A lot of insurance companies even barely make any profit. I don't think that will be the case for Lemonade, but that would be a really, you're saying, well, it's really only worth $20 a share based on your 2032 value discounted back. I think that's going to be too pessimistic because there's companies like, you're basically saying your market efficiency is going to suck and your pricing is going to suck all at the same time. So, so even if we make this a little more sensitive, not 75, but let's say like 72%, and let's see, we'll flip that in there, and we'll go back, find where we were here. Even at 72%, 73% net loss ratio, and that poor conversion rate, you're still sort of saying, yeah, it's worth between $40 to $100 per share. It would be a pretty fair, probably approximation of the price. So it's not even ridiculous at $60 a share. But I really think these metrics are kind of ridiculous because, Lemonade. Let me go on a little rant for a second. Some people think, Lemonade, they're just going to pass on all of the profits always to their customers, no matter what. And they're going to keep their prices, bottom of the barrel, cheap as they can forever. And so they're not going to have a loss ratio that's better than, say, 75%. And I think that's hogwash. I think that doesn't make sense because you have to start with thinking about the infrastructure they're building. They're building this phenomenal infrastructure that can measure the risk profile of every single customer they interact with in phenomenal ways. Like, just take the car, for example. Progressive I did a whole video on this. Progressive is one of the telematics leaders in the car industry, but they don't even reveal what percentage of their customers use telematics. It's probably like 30, maybe 40% at most use telematics based on the data I could dig up. And Progressive themselves literally says the most predictive metric to measure a car customer's risk by far is your telematics driving, how much you drive, the style in which you drive. It's not like the color of your car doesn't actually matter, or your age doesn't really matter as much, those kind of things, or your income level, etc. But the biggest metric, that sort of important metric by far, or variable or influence, is your telematics score. And so that's coming from Progressive, one of the best leaders in telematics, who only has maybe 30-40% adoption. This is versus Lemonade, which has 90+% adoption and a tiny, barely scratching the surface of the car product. I think Lemonade's going to do two things. They're going to be able to offer the very best prices to the very best customers, and also have phenomenal loss ratios that are not going to be, I don't think are going to be like in the steady state limit 75%. I would not be surprised if they are in the 60% range. I mean, you look at a company like Root that's only doing car, and their loss ratios are higher, and then they've come down. I think I forget, in the high 50s or 60% for car. And I think they're the sort of blueprint of what Lemonade's going to be able to accomplish with their own car product, but they're going to have really advantageous variable acquisition variable spend here, because Lemonade's going to be able to cross-sell to their existing book of business and keep selling and growing the top line, their customer base in the sort of unloved products of pet renters, those sort of products all around the world, right? So I think Lemonade, they're going to be able to become the most loved insurance company. And that means offering, phenomenal prices to the safest people, but they're also going to be able to have a phenomenal amount of profit. I think they're going to be able to do both. It just makes sense based on the tech stack they've built, based on the infrastructure they built. If you think about that carefully, it makes perfect sense. They're not going to be 75%. I mean, we can forecast that for fun and answer this question and say, look, maybe they're worth at least $40 a share, maybe $100 a share, depending on how far out you look. But I think that's overly pessimistic based on the facts we have and the knowledge we have of sort of the company that is being constructed and built. So, and Rant on that. But again, where the bottom might end up, I don't know. Maybe this is $2. I think that's kind of as low as you'd go, especially when you're barely scratching the surface on car, and they're already 2 to 3 is typically where they're ending up. Loss ratio, maybe 73% net loss ratio, and your operating expenses growing 5%, you're worth $40 to $130 a share. Maybe that's a good enough answer for that. But if I back up my model again, just to sort of end the video here, and I go back on those metrics there, it's like, I think it's more realistically, they're like $100 to $150 a share. And the market can do crazy things. They might they start hitting profitability here. I don't know if it's this year, a couple of years from now. Like, you look at companies like Palantir and how bananas the evaluation went, and the market could go, man, they're not worth 30x of their, 30 times 2032. They're worth 100 times that. And then you could say, wow, you could go to like, by 2027, means you're worth like $400 a share. Would be fair value at that range, or what the market might award that to get you there, right? So crazy things have happened, but if I had to answer it, I'd put it in that range. So this was a long video. I had a lot of questions to cover here. I really hope, I think the rest of 2025 is going to be really strong. Just to kind of wrap things up here, I think is a good chance first quarter comes positive adjusted EBITDA, maybe is in Q4 of this year. And I think 2026 might be full year positive. There's, I think, more likely than not chance of that. Present value, you're probably at least $100 to $150 a share. You can make the case you're like $200 to $300 a share even. But I think you can be pretty confident we're worth 90 to 150 is what my answer would be. And then what would be the worst case present value now? I mean, yeah, I think like even $40 a share to 40 to $100 a share kind of would be, I would put it more as your worst case. Of course, you can make the numbers even worse. You could say it's just going to go bankrupt and they'll never flip to positive profitability. Of course, in that case, they're not really worth anything. But based on some reasonably but very, in my mind, still very bearish, very pessimistic numbers, you can still say, hey, they're worth $40 to $100 a share right now. So I hope this was super helpful. Please join my Patreon. It's Matt. Like I said, I had a goal to get to 200 people by the end of this year. We're at 120. No, we're at, hold on, 161 or 2 or 3 or something like that already. So if you want to join and get, I encourage you, play with this yourself. Yeah, it can really, I think, enlighten you on sort of where the sort of possible metrics move things. Thank you so much for watching. Remember, it's in the bag.